there might be an energy shock incoming because the Strait of Hormuz has basically stopped, well, not stopped, but ships stopped moving through it freely as they would just basically a few weeks ago or just a week ago. At the same time, today, Trump offers shipping protection for vessels going through the Strait of Hormuz. And if you don't know, well, I think 1/5 of the global oil supply and the liquid natural gas goes through the Strait of Hormuz. And part of it, I think the narrow part of it, of the strait goes through Iran, where we have a conflict currently. And Iran is basically saying that they will shoot down ships and whatnot. Now, I think this is something that most don't see, but there might be a massive energy shock, and prices can go up to like $100 really easily, really quickly. And I think a lot of people overlook it and go ahead and open short call positions right now. And I'll show you what these positions look like right now, because they do look pretty tempting. But at the same time, for natural gas and crude oil, things can get really ugly. And if they do, then I have a very specific plan that I want to initiate to basically make a very nice return, and possibly even like a something that can create generational wealth for a lot of people with options and with futures. So with that, let's take a look at what kind of call options we can get for crude oil, and from there I'll keep getting to my point of what exactly you can do and what signals to wait for before doing it, or to signals to wait for and only then executing. So even if we go to 14 days to expiration, and because it's a short call, this is where all the risk is. I would only ever go to and open only one contract per every $100,000, because otherwise it can be a lot of chaos. And even though it's not basically maybe not that leveraged, but at the same time, volatility expands as price moves up on crude oil and natural gas, in this case specifically as well. So I want to make sure that I can handle a price increase, because I'm definitely not going to be able to call the top or the bottom, the top in this case. So let's, for example, see if we can go to the 99 strike call option. And I think we can collect like $1,000. So it will be a pretty nice premium for of $1,000 in just 14 days, right? And if you look at the strike, it will be at $99. So really far out of the money currently, right? So it looks very tempting. And the problem is, people not only like open calls right now, which is, I can understand, but they open multiple contracts instead of opening just, one per 100K. They'll go ahead and open 4 or 5 of them. And then you're extremely over leveraged, and any move to the upward to the upside will create a crazy amount of volatility, and option premiums will go up. So it's really far out, even with 24 days. And before I continue, if you wonder what is this line, this is a short put I currently have on my position. I sold it on Thursday evening, so right when price was at about 65.5, and obviously things have escalated since, and the position is doing very good. So this is this line over here. But let's take a look at what kind of strike we can, or what kind of premium and strikes we can get if we go to the 44 days to expiration. And there we go. So 44 days to expiration. Let's see here. This is actually also the May contract. So crude oil, we'll go to May, different contract. So let's see how far we can go out and maybe collect maybe 2% on the account in credit. So let's see what it looks like if you go to this strike price, which is $2, strike 102, which is again very far out of the money. But this option has more days to it. So what is my plan for crude oil if there's an actual energy shock? Which if would happen, it would happen in probably a week or two if things keep being this way in the Strait of Hormuz and ships are unable to go through. Price would probably skyrocket $70, $80, $90. I'm not sure exactly what it is. And I'm probably going to go so far out of the money, and I will go based on the credit in this case. So I will stick to one contract per 100K. And because we have two pretty close expirations, and 14 days is not much, and this is where I currently have my position on. But if the credit will be sufficient and I can collect 1% of my account per one contract and be far enough out of the money, and far enough, for me would be, the same distance that we are right now from, for example, from the $100 or $99 call strike. So this is an additional 30%, 33% upside, right? So I'm probably going to be looking for whatever will let me collect 1% of my account in credit, and I'm only going to take one contract per 100K. So I'm assuming if price will be at $90, I can probably, volatility will be so high, you can probably easily would go to like $150, $160 and collect that 1% and being just, really, really conservative and safe. And this is obviously not the wealth generating income that I'm talking about, but this is a safe move that I'm definitely going to be doing, and I'll talk about the other thing in just a second. But for the expiration, depends on what's when is it going to happen. I don't think it's going to happen in the next few days, so I'm probably going to stick to this expiration, because if something like this would happen, it would happen within a few weeks, and this will be the closest expiration we have for crude oil. So for natural gas, it will be kind of the exact same deal. Volatility is still pretty low for natural gas, but it can increase quite a bit. And let's see here what kind of expirations we have for natural gas. So we have 23 days. So depending on, again, when is it going to happen, but let's say it's going to happen probably within this expiration, which is the May expiring contract, which is right this one. And again, I'm going to be looking to collect here, well, probably I would say 2 contracts per 100K on in this case. So let's see here right now, the premiums are actually not that high. So this will be about 1%. So, and this is 3.85. So 3.85 is really close to the current prices you can see. And this is because, even though the price of crude oil, of natural gas did go up due to the Middle East tensions, volatility barely moved. It moved up, but not a lot relatively. And you can see a short call, which is like outside the expected move, right? 3.85. It's still pretty close. It's still within a normal movement range of natural gas. So we need to wait for a situation where it's very very comparable to crude oil in terms of volatility. Now, what is my great idea to generate a crazy return? Well, it's very simple. It's probably going to be going short the crude oil contract. Again, just one contract, and I want to see some crazy volatility to the upside, because eventually the Strait of Hormuz will go back to normal. This is not some kind of world-ending war kind of thing. But at the same time, it can create a lot of volatility and a great opportunity to short. So if, for example, if we can short, if prices, let's say it's at $100, for example, and we can short one contract and it goes back to, let's say $70, which is, pretty normal. So we're looking at about 30 points, and each point is $1,000 here. So 30 times 1,000 will be about $30,000 on an account of $100,000, right? So you'll be making 30% on the account within, in a matter of a few weeks, which is pretty massive. And some people can take more leverage, sure, but I'm working with $9.38 million of family capital. So making 30% on this, it's pretty sweet, obviously, and it will be very, very welcomed given the situation. So this is kind of the grand plan. Kind of the same thing with natural gas. Just short natural gas if price explodes really abnormally, because again, things will go back to normal. The US is way overpowered comparing to Iran, and the Strait of Hormuz is gonna end up being open. Now, what happens if there is no energy shock at the end of the day? the Strait of Hormuz just opens up, what is the plan then? Well, you can do, I will probably do the exact same thing. I will probably sell some calls on crude oil with short expiration, very far out of the money. Kind of the exact same thing that I would do if there is an incoming energy shock. Because at the end of the day, if it opens up, it means there's going to be less volatility to the call side, and we can benefit in both situations. So either way, we have a setup here, just kind of waiting to be unfolded, and I guess I'm waiting for the right conditions. But it will be a really good opportunity to profit. Maybe not as much as I wanted to, but still profit is profit, and good high probability opportunities are there to be taken advantage of. And obviously, if you keep the risk pretty small, you can keep doing it over and over again and having some great success. So thank you again. If you have any questions, let me know. I'll keep you posted of any move that I make, and I will catch you in the next one.